It's turning out to be quite a fantastic Friday, if I can say so myself. The Nifty is still holding on to gains of 260 points right now. It's come off a little bit from the day's highs, but stable as can be. A lot of companies reacting well to their earnings. Angel One is up almost about 5% after reporting its highest ever quarterly revenues, and something like an Anand Rathi also reporting good earnings. So a lot of stock-specific reactions there. But let's get you an overall perspective on the market. We won't get the stocks at cheap prices in India. Now, these are not my words. They're words coming in from Kenneth Andrade of Old Bridge Capital Management. He goes on to say that investors need to wait for some more time and good news is not far away. Listen in to that exclusive conversation that Prashant had as he quizzed him on Indian market valuations, commodities, IT services and the consumption space.
Valuations apart, which I think it's already there. I mean, when I look at our portfolio under construct, out of the 20 odd names that we have, at least 5 or 6 of them are almost at price to book of 1. Okay, in my experience and my history that I've managed money, I've never seen 25% of my portfolio having a price to book of 1. Okay.
25% of the portfolio.
25% of the names that are there are price to book of number 1. There are very few companies that have not that exist in the Indian environment that have not gone through that stress test and have come back extremely profitably. So balance sheets have also cleaned up. India corporate is sitting at a historical low in
leverage,
historical low. So we've got data since 1999. 99 data goes back to say that corporate, the BSE 500 manufacturing or non-banking businesses were at a debt equity of 0.6. We're down to a debt equity of 0.5.
Sure.
Plus, we've got capacity at 75%. Now, this is a killer combination. I mean, you got capacity utilization at 75%, and you got all the capacity to leverage. You got operating leverage and you got financial leverage. So my sense is that you're not going to get stock cheap in India, right? The only thing is that you got to wait it out for some time. You got to wait for the good news, and the good news is not very far away.
Let's get to one area which you really like. I'm talking about commodities, both soft commodities and hard commodities. It's a bit of an anti-consensus kind of view, more so on the hard commodities as compared to soft commodities. Explain why you like that space. What's the basic thesis?
This is the first time, I think, one of the very few times since India's independence, where virtually all crop prices are trading higher than MSPs. Okay. This is the first time that we've seen in history, that you've got a large industrialization of agriculture. When I say industrialization, agriculture moving into industrial products, right? You've seen it through the ethanol policy. You will see it getting converted into plastic or single-use plastic over the course of the next year, 2 years or 3 years. So you've got a new use or new demand pattern emerging for agriculture, and that's kept that along with relatively weak or not favorable monsoons has kept supply reasonably tight.
Right.
Okay, new demand and supply tight, and that's created what we have today.
Right.
I don't ever think that commodity prices will ever be deflationary for a long period of time. One is you got a population growth,
and these are global commodities.
Global commodities. I'm talking. Right. Once you got demand getting created from another stream of. From another industry completely. Plus you got food consumption going up. Plus you have protein consumption actually moving higher, and all three of them are going to keep prices elevated. Now, when prices get elevated, I mean, let's look at it from a hard commodity standpoint. When say steel does well, the value chain works all the way down to iron ore and coke. So when agricultural commodity prices do well, what happens on the entire value chain? So there are elements of everything that is falling into place. Now we've been holding this since 2016, and the fundamentals of this argument tend to get a little better by every year. So I'm not too worried about it. Policy interventions always come through because at the end of the day you will necessarily need to control pricing because of inflation. But if there is no supply, there is always going to be a challenge.
This position in the agriculture space you've been holding since 2016, you're saying?
16 already.
And you're happy to hold, continue to hold?
Well, valuations are fair. It's an industry which is consolidated. There is no second or there is no third manufacturer of any of these products out there. And even the converters are getting more consolidated than they have ever been before.
IT is a large sector, right? Which has been kind of bombed out because of what's happening. Does that interest you? I mean, that qualifies your 52-week low criteria.
Yes. But they're still up almost 80% since for the last 3 years, right? So they've done extremely well as far as these businesses are concerned. And they've done so because everything's gone in favor of these companies. But what has not gone in favor of these companies is obviously their cost of manpower. I think all of that is getting addressed right now. So valuations are the best that are much better than they've ever looked before. If you go back to that database of IT companies out there, you'll get someone who's available at a 10% cash flow yield. You'll get companies available at a 5% dividend yield. So yes, value in that segment at a 52-week low in a number of those names is emerging, and it's emerging rapidly.
Kenneth, the other space is consumption, and you own a QSR company in your portfolio, you own a liquor company in your portfolio, so you like that space. I mean, urban consumption, really. Just sort of explain that to us.
I think we're just coming back on the fact that the urbanization will pick up a lot of pace at this point in time, and you just have to get companies with and the sense is we just get companies in the right format, with the right expansion plan, and with the right cost structures. Okay. So one of the biggest cost structures, I mean, if you look at most of the QSRs, one of the biggest cost structures is royalty payments.
Sure.
Okay. Yes. So if you can actually align your portfolio to take that 5% to 7% cost out, you probably got a business which does have the pricing advantage compared to everyone else. And these businesses are free cash flow. They got their marketplace, they're free cash flow. All expansions are through their own cash flows or through their own balance sheet, and no dependence on any external resource. So we're in infancy in that industry, and globally that industry has become significantly large. Right. So there will be an expansion of that one particular place, and it could get reasonably large. A similar thing with the alcohol beverages companies, very consolidated place, enormous barriers to entry, both in terms of distribution and making the product price available. So all of these companies come in with their individual structures, wherein it's extremely difficult for competition to come in and
disrupt that business. Take away market share.
So if you can get all of these at the right price points, you go back about 3 years and all of these were there. You go back to IPO stages, and when these businesses corrected, they were all there. I think you just have to wait your time on all of these companies, accumulate large amounts, and just wait for them to monetize it all.
You own a urban waste management company as well. Is that a? I mean, there are very few plays on that theme. Really, if you want an exposure, is that a? I mean, you want to talk about that briefly?
So for me, if I have to bracket that company into a particular economy within the country, it will definitely go in line with the consumer economy in the country. Sure. Why? Sure. Okay. Why does an urban infrastructure company get categorized as a consumption business? Because simply put, the higher the per capita of the city gets, okay, sure. The more the municipality will spend, or more the authorities will spend on social infrastructure. Right.
Hopefully.
No, that is always a underlying demand that will always be there. Right. It is water, waste, and sanitation. Right. It is definitely there, and you've seen this happen. You've seen this happen in all underdeveloped economies to a developed economy, right? And these are the three places that are there. And I think if you look at the Indian context, large concentrated pools of individuals into smaller island cities or cities, the need for infrastructure like that to build out is the demand is far ahead of
But this
what is
also
available.
means a lot of interaction with governments, municipalities for that matter, local government bodies. I mean, is that a risk at all, or that's a risk you're willing to take given the opportunity size?
So, how much of that is factored into the valuations is what you need to check. And if it's available at a 10% cash flow yield, what's the problem?
Got it.
Okay. So what we do from an investment process is we actually look for the reasons why others do not want to invest in, the reasons why these companies are available at that pricing, and once they establish that the inverted comma growth cycle, we monetize that holding.
All right, that is one true actual value investor looking for bargains, actually trying to buy stocks at 52-week lows rather than chase momentum. You can watch that interview, Kenneth Andrade, Foldbridge Capital Management, all day here on CNBC-TV18. All right, 270 points now on the Nifty is what we have. So let's talk about here and now in terms of what should one do. 35 minutes of trade is behind us, and the market is still holding, not quite at the day's high. So the high is 17,331, and we've given up about 50 odd points, 4750 points from the day's high. Mitesh is with us to tell us what he would want to do. Mitesh, is there a trade here?
So, Prashant, on the Nifty, we are still hovering around that 17,300 mark. The simple trade would be to wait for the day's high to be taken out. Once that happens, you can take a 40-point stop and go long. And the first target here should be about 17,410, but that's only a small pivot. And eventually, I think, there's a good chance that we are looking at 17,550, 580 zones to be with it. Having said that, on stock side, Reliance is something which has come on my radar, I think, and Tech Mahindra. These are the two buy calls I'm looking at. Reliance can be bought with a stop just below levels of 23.80 and a target of around 24.45 can be looked at. Tech Mahindra, along with other IT names, has broken out. So buy with a stop at 1,020 for targets of 1,080.
Hey, by the way, there are plenty of stocks hitting fresh highs this morning. Sun Pharma is at a fresh 52-week high right now, so keep tracking that. TVS Motor is at a fresh high of 1,095. That's a gain of almost 75% that TVS Motor has seen this year. And a lot of result reactions. Anand Rathi is actually the big mover in the broader markets, up almost 6% now on the back of a strong set of numbers that Anand Rathi has reported. Well, is that kind of a market as well, where any good news is being rewarded in a big way, given the overall sentiment? But the spotlight is yet again on the IT space. Infosys is top of mind. Post a good set of numbers. Reema's here to give us the latest on that. Reema, over to you.
Thanks so much for that. The big beat in Q2 margins, the very strong deal wins, which have gone up by nearly 50% on a quarter-on-quarter basis, plus the buyback support, all that is contributing to the up move that we're seeing in Infosys today. Just to quickly run you through the numbers, there was a bit of a miss on the top line. So constant currency revenue growth of 4% was slightly softer than what the street was anticipating, but the company more than made up by the very strong 150 basis points margin improvement on a sequential basis. So EBIT margins at 21.5% came in as a big surprise and a big positive. In terms of the FY23 guidance, the company has raised the lower end of its revenue guidance. So earlier they were expecting a 14 to 16% growth. Now they're looking at 15 to 16% growth. On the margin guidance, the upper end has been brought down. Now they're anticipating a 21 to 22% margin performance for the full quarter. As I said, the deal wins were very strong. Deal wins have come in at $2.7 billion this quarter, much higher than the 4-quarter average of about $2.1 billion. That's a positive. Attrition too has seen a bit of an easing on a quarter-on-quarter basis. And plus, you've got that buyback that everyone was watching out for, 9,300 crore of an open buyback, of an open market buyback. And the buyback price is at a premium of 30% to where the stock closed yesterday. This is higher than the 20-25% premium that we've seen in the last couple of quarters. Brokerages on the whole are positive on Infosys. They have been, and these numbers reiterate the confidence. And we've put up the target price of various brokerages on Infosys for you. Back to you.
All right, thanks a lot for that, Reema. Well, let's hear out the company's MD and CEO, Salil Parekh, on issues ranging from margin guidance, hiring, and moonlighting. Let's hear him out.
We've seen, as we go through the quarters, normally we reduce the band of the guidance as we see more visibility within the full financial year. We've seen very good large deals momentum. We've seen good pipeline and a good Q1 and Q2 on growth. And there we've made the guidance in the top end. So we had 14 to 16 and now we made 15 to 16, which is at the higher end of the guidance, which gives us more confidence and visibility of what is going on within the year. Margin guidance, last quarter we had said that our guidance was 21 to 23%, but that we would be closer to the lower end of the guidance. As we've come in here for this year specifically, since we felt we were going to be at the lower end of that, closer to the 21% in the guidance, we've decided to reduce the band. We don't see any indication of a change in terms from the past years of what the quantum will be, but there are always furloughs, so that seasonality comes in. But the recruiting at 10,000 is a very strong number, and we've already had, as you mentioned, good recruiting in the last few quarters. Last year we had 80,000 college graduates. We're also making sure that the macro points we discussed earlier, we're keeping that in mind.
Okay, let's slip into a quick break on that note, but there are plenty of stocks moving around, so we'll get talking about that in just a bit. Stay tuned.
जिंदगी को दें रफ्तार, शुरू करें इसी त्योहार, खुशियों का सफर बिताएं साथ मिलकर। त्योहार तभी हो जब अपने साथ हो। SBI के संग इस त्योहार छोटी किश्त से बड़ी खुशियां ले आए। SBI, the banker to every Indian.
Suzlon Energy Limited, largest installed base in India as a wind energy OEM, market leader in India with significant experience across the entire wind energy value chain, contributing towards approximately 33% of India's installed wind energy base. The Suzlon Energy Limited rights issue of 2,400,000,000 partly paid up equity shares of face value of ₹2 each for cash at a price of ₹5 per share. Opens on 11th October, closes on 20th October. For more details, refer to the letter of offer.
New car launches, new wider highways, fast doorstep deliveries are all signs of a boom in India's transportation and logistics team. Now you too can be a part of it with ICICI Prudential Transportation and Logistics Fund that aims to accelerate your portfolio. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.
My journey of insurance and investments began at the same time, when I invested in LIC SEEP. In this fast-moving world, SEEP can balance your funds with security and growth. SEEP will take care of the ups and downs of the market and will give you fruitful results so that you enjoy the ride. And when SEEP is with you, you can soar high!
LIC's unit-linked insurance plan SEEP offers savings and protection so that you can soar high in your life. LIC, हर पल आपके साथ.
Happiness is getting home solid wood furniture this Diwali from Insaraf.com, India's #1 solid wood furniture store.
Indiabulls Housing Finance Limited announces a public issue of secured redeemable NCDs, offering coupon rate of up to 9.55% per annum and additional incentive of 0.25% per annum. Tranche 3 issue is open for subscription. To subscribe, log on to indiabullshomeloans.com. For risk factors and more details, refer to the Tranche 3 prospectus available on the websites of SEBI, Stock Exchange, Company and the lead managers.
Welcome back to Corporate Radar. Well, for now, the market is holding up with 290 points in the green on the Nifty. So let's get you a special segment, Quarter Se Quarter Tak. Today, we talk about the insurance segment. Surbhi is here to tell us what we can expect from the insurance sector this quarter. Surbhi.
Life insurance players are likely to see moderate growth this quarter as the base Q2 FY22 turns normal. Remember, Q1 of FY22 was affected by the Delta wave. The growth slowdown did not come as a big surprise as the industry witnessed weak demand in the retail protection segment. Demand for saving products was also impacted because of the volatility in the capital markets. Apart from LIC, Other listed life insurance companies reported an APE growth of anywhere between -8% to +3% in the second quarter. LIC grew by close to 35%, driven by better growth in the group segment. Analyst estimates suggest that the growth in value of new business, that is VNB, will range anywhere between -10% to +10%. This is excluding LIC. The negative impact of the lower retail protection in the product mix will be offset by higher non-par savings product and stronger credit offtake. Additionally, the reducing share of low-margin unit-linked products will likely lead to a 50 to 350 basis points year-on-year expansion in VNB margins. Almost all of the VNB growth is likely to be driven by margin expansion. Our poll suggests that SBI Life and iPro Life's margin improvement will stand out on a year-on-year basis due to their strong growth in non-par saving products. The embedded value for the first half of the fiscal is expected this quarter. MK expects that the embedded value growth will be slightly weaker due to the material negative economic variance. In spite of the benign operational performance and impressive operating profits, the negative impact of the spike in bond yields will result in a slightly weaker embedded value growth. However, they expect this economic volatility will offset over time. With subdued Q2 growth, all eyes will be on the management commentary for growth in the second half. Finally, we leave you with the valuations of life insurance companies on price by embedded value basis. LIC here is at 0.7 times, highly undervalued.
Okay, thanks a lot, Surbhi, for that. In fact, let's get Nishchint Chawati, the senior analyst at Kotak Institutional Equities now. He's joining in. Nishchint, good morning. I was going through your report where you do speak about how the APE growth has been very subdued for the sector overall. And within that, individual players like HDFC Life, Max Life, hardly any growth over there. In fact, a degrowth for some of them like Max. Just take us through when you expect a recovery to come through and what is the commentary that you're looking out for from the management?
Sure. See, what we need to keep in mind was that first quarter of last year was hit because of the second COVID wave, and there was some bounce back of business in the second quarter, and which is probably the reason why you are able to see some weakness in the overall APE numbers. Secondly, the high volume the high volume ULIP business was weaker this year because of a more subdued equity market, and that also affects APE growth to quite a large extent. One would say that you would expect better numbers in the fourth quarter, somewhere going closer to the fourth quarter. But my sense is that the overall focus will be on VNB growth rather than kind of just looking at APE growth. Again, the discussion is obviously more on the top four listed players. But if I look at the overall industry, there have been some of the smaller players, or I would say that beyond the top four players, who have been growing at a faster pace. So you have got Bajaj, who's grown faster. You've got Tata AI, who's grown faster, and some of the other smaller players as well. And I think from an overall industry point of view, maybe that is also one trend which is playing out. But yes, overall industry growth numbers have been weak. Probably expect the base effect and momentum to pick up somewhere going closer towards the fourth quarter.
Nishchint, hi, good morning. There are big pockets of sort of not mispricing, correctly priced, but valuation differences, right? There is LIC in one hand. In the private side, Max Financial trades at a much cheaper valuation as compared to the others. Which are best placed from here? Which are your best bets given growth prospects for the industry and for these companies?
Sure. So HDFC Life and SBI, in our view, are best placed at this point of time. HDFC Life has consistently been, the bellwether of the industry, launching new products, and gaining market share ahead of time. In the last 1 year, they have been almost kind of flattish as far as market share is concerned, and probably that's what has got reflected in the stock performance as well. SBI Life is doing extremely well, clearly supported by the parent, and obviously their execution playing out quite well at this point of time as well. So our view is amongst the four listed players, I think these two players are best placed at this point of time.
Okay, SBI Life and HDFC Life best placed. Do you track general insurance as well, ICICI Lombard, Nishchint?
Yes.
What should we expect there? I mean, the underperformance continues. There was a brief period of hope around the last quarter numbers, and the stock did well, I think, right out of it, but then just went south after that. What's your view there, ICICI Lombard?
See, here again, I think what is affecting the stock more is the the disruption in the industry. We have seen some of the smaller players being very aggressive on pricing. I believe that in the last quarter, the overall industry combined ratio was well above 100%, and that is probably what is affecting growth for some of the larger players. Or somebody like a Lombard will probably want to wait on the side, kind of then pushing growth very aggressively. So on the pure motor segment, I mean, while ICICI Lombard's numbers picked up on a YY basis, on a pure pure motor business, which is sort of the holy grail of the general insurance sector, their growth was fairly subdued in the first 2 months, and I think we'll have to wait out a little bit in terms of how the how pricing improves on the motor side. I think that's going to be a little more crucial for the business.
Okay, so overall the industry, the insurance industry has seen what, a 10-11% compounded growth rate, right, over the last few years. Is there any change in the estimates going forward? What do you think the average growth could be? And which are the companies that could be the biggest beneficiary of this growth?
Sure. See, I think if I have to look at from a slightly longer term perspective and keep the COVID disruption aside, we are looking at anywhere in the range of around 15 to 16% kind of a growth. Probably need to look at a slightly longer time frame, because there was a lot of disruption during COVID. Motor sales were weak on the non-life side. On the life side, you could not push quite a few products and so on. Our sense is that this is something which will this kind of a trend is something which should continue. Probably you will have share of higher margin products. Maybe ULIPs growing at a slower pace and the other products probably growing at a faster pace, which would mean that VNB acceleration could be better. Within the space, we prefer life as a more long-term play on insurance over the non-life space, simply because of the fact that non-life space is more vulnerable to disruption.
Okay. Nishchint, pleasure speaking to you. Thanks a lot for joining in. So that's a quick update on what to expect from the insurance industry this time around. But let's shift focus to the commodity markets now. Manisha is here with us in the studio to tell us about the one commodity that she's tracking today and could be the big one of the day. Manisha, over to you.
Sonia, thank you so much for that. The way we look at copper as a barometer on where the economy is going, same way when you look at the agricultural commodities, you look at cotton prices here, because that's a discretionary spending. You see textile buying or fabric buying only when you are looking at good market economics there. So for cotton prices, we are looking at an 18-month lows in the international markets. For the Indian markets as well, the kind of rebound that you're seeing is coming in after a big sell-off that we have seen here. So when you look at this week, we're down by nearly 7%. And in the last 1 month, we're down by 19% when it comes to the cotton prices there. But it has to do with the weak export orders that we are seeing. The retail demand hasn't been picking up as well. And the strong US dollar continues to weigh on to many of these commodities. For the Indian cotton prices, we've come down all the way from all-time highs of 52,000 rupees per bales to 32,000 on your screens here. There have been reports of soaring operational costs as well. And the demand in the downstream industry also is reported to be on the poorer side. When you look at the spinning mills in the overall Indian markets, we do understand that there are capacity cuts of nearly 40 to 60%, especially when you look at Andhra Pradesh, which is like a hub of cotton and textile there. There are mills running at 50% of capacity, something that they have been reiterating for many of these months now. There are 125 textile mills in Andhra Pradesh, and they tell us that the capacity of this is 34 lakh spindles. And amongst this, nearly 100 of these spinning mills are actually working with 50 to 60% of less capacity there. There is even slower demand for cheap polyester yarn. So the retail buying really seems to be slowing at this point in time, weighing onto the cotton prices there. If you look at the overall production this time around, last year was 31.5 million bales. This time around, we're looking at a higher cotton production as well at around 36 million bales. The October rains did lead to some buying in case of cotton, but the assessment is that there is not too much of damage on cotton, and is the reason you have seen some sell come in there as well. This is what the spot prices have done. We started Jan with 60,000 rupees per candy. We saw an all-time high of 1.10 lakh rupees per candy, and currently trading at 70,000. And this is for October. When you look at November and December pricing for the future months, it is as low as 65,000 on the lower side. So the expectation that the cotton prices could decline further from here.
All right. Manisha, thank you very much for that. The market here, meanwhile, is right in the middle of the range. The day ranges from the high to the low 60 points, and we are exactly in the middle of it. The high was 17,330. The low is 60 points under it, and we're at 17,300. 30 points off low, 30 points off high. You need a break above the high to perhaps give confidence that one can go long and make money from here. So one needs to wait for that. We'll see if that happens. But for now, it's time for a quick break. On the other side, it's our segment. It's the economy. My colleague Lata will discuss the most important number of the moment, the US September consumer price inflation number and its implications, with Aditya Bhave of Bank of America Securities and Robert Connell of ING Bank. Stay tuned for that conversation.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.
आग को फैलने से रोकना मुश्किल है, पर नामुमकिन नहीं। अब फायरवॉल टेक्नोलॉजी के साथ सेंचुरी प्लाई क्लब प्राइम आग से बचाए।
Will snow days be a thing of the past? Or are we smarter than that?
हर मुश्किल दरअसल एक मौका है, जब जज्बा जीत का साथ हो। सड़कें चाहे जैसी हों, मंजिल चाहे दूर से ही, खुद पे मुझे भरोसा है, मानूंगा मैं हार नहीं।
टाटा इंट्रा V50 सब कुछ उठाए, हर दिन जिताए।
ये वक्त है खुशहाली के आने का, ये वक्त है जीवन को रोशन कर जाने का, ये उत्सव है असली कारीगरी का, ये वक्त है समृद्धि को घर लाने का।
We care for your best interest. Presenting the Canara Bank Special Deposit Scheme. Now offering 7.5% per annum for 666 days. Apply online or visit our nearest branch now. Canara Bank. Together we can.
On It's the Economy today, we are discussing the most important number of the moment, the September US CPI inflation number. Came in at red hot 8.2% versus market expectation of 8.1%. The markets, however, sprung a surprise. After an initial decline, the Dow, S&P and the Nasdaq indices rebounded smartly to post record one-day gains. However, the CME Fed Watch tool, it's a tool which tells you what people are expecting the Fed to do. That indicated the market expects the Fed to hike by 75 in November. That's sealed, but also a good 61% expect a 75 basis hike in December as well. Earlier, the expectation was 50 basis. Now, what does this mean for the US, the world, and for emerging markets? I have with me Aditya Bhave, senior US and global economist at Bank of America Securities. And we are also connecting with Robert Connell, head research and chief economist, Asia Pacific at ING Bank. Gentlemen, thank you very much. Robert, with your permission, I'm starting with Aditya because he has stayed up for us all the way from the United States. Aditya, before the inflation number analysis, can you explain why your market behaved the way it did, that huge rebound?
Thanks, Lata. It's my pleasure to be on. I think it's a combination of a few things. First off, there was some significant unwinding of positioning. And second, I think investors took a fairly optimistic view of the inflation numbers. So the interpretation there was that core goods inflation came in quite soft, while the strength in inflation was in core services, particularly shelter-related inflation, which is broadly expected to fall because there's a lag in the way in which it's measured.
Okay, so a certain certainty about inflation falling. But according to the CME FedWatch tool that I referred to, the bets for a 75 basis hike in December has gone up very sharply, 61%, Aditya. So have you changed it? Are you also expecting 75 in December?
That's right. So our base case was already a 75 basis point hike in November. We stick with that. For December, we're sticking with 50 at the moment, although obviously we acknowledge that with this inflation print, the risks of a 75 basis point hike in December as well have also increased. The caution that I would add on that is that we are going to get 2 more inflation prints and 2 more jobs reports before the December Fed meeting. So there is, significant room for the data to move before that meeting actually happens.
Oh, yes, there is that. I agree with you. On that note, Robert Carnell, welcome to this chat. What is your expectation now? Are you also penciling in more rate hikes from the Fed?
Well, I think like Aditya, you have to wait and see where the data goes from here. Last night's data was unhelpful from the point of view of wanting to see, perhaps an end to the Fed tightening. That's clearly still quite a way off. And of course, we've got retail sales coming out tonight as well. And the data becomes very, very complicated now where, you're looking for bad news really to be good news. And, in spite of what Aditya said about the sort of split in the service makeup, it is quite remarkable that the equity market looked at numbers which, on the face of it, basically said rates are going to go up faster, go higher, and stay higher longer, and then decided to rally on it. It's not entirely sensible, even if you're doing moving, getting rid of some positions. You have to look at this and think this isn't going to last very long. This looks like a very temporary adjustment in policies, and you've got to really think that the bond market usually gets it right more than the equity market.
Oh, yes. On that note, let me get the growth macro changes from Aditya. Aditya, have you changed any of your macro forecasts, like US or global growth numbers?
If the Fed went 75 in December, we would become more concerned about weaker growth. So recently, we increased our terminal rate forecast by about 50 basis points to nearly 5%. And when we did that, we penciled in a slightly deeper recession than we already had in our forecasts. So more rate hikes beyond that, if we were to add those into our forecast, then most certainly we would become concerned about a deeper recession still.
Robert, a similar question to you. Now with perhaps a new fait accompli, I agree with you, you haven't called it a fait accompli yet. There are many numbers from now to December and thereafter as well. But is a 5% peak rate a fait accompli for you? And if it is, are you more worried about any of the macros like EM growth?
No, it's not a fait accompli. The market's got almost 5% priced in by May next year, but a lot can happen between now and then. There's actually a lot of the inflation number that should start dropping out fairly quickly once we get into 2023. Base effects are doing an awful lot of the heavy lifting at the moment. Clearly, there is some genuine underlying inflation that needs to be squeezed out of the economy as well. And then we get this sort of difficult dynamic between the macro side and what the Fed has to do, because we do actually need to see the macroeconomy, the US economy slowing down to get these inflation numbers down towards, probably not at, but towards their target range. So, every time you see a piece of good data, it's not really very helpful. We actually do need to see these numbers coming off.
You're not at the moment reducing your growth forecast for any of the Asian economies, Robert?
Yeah, we've been trimming them, throughout much of the year as inflation has stayed and been stickier than was originally expected, as local central banks have increased interest rates. The inflation numbers themselves weigh on consumer spending and reduce real spending power. So, there's been a constant kind of trimming. Perhaps we've been sort of following rather than leading, but it's definitely been on a downward trajectory through most of the year.
Okay. Just before I carry on with the macros, Aditya, a too fast, too sharp rise in rates has caused a near accident in the United Kingdom. Do you think we could see something like that in the non-bank, in the shadow of financial space in the US and in other countries?
It's a risk, but I think it's a relatively low risk for a couple of reasons. The first is that the US is in a different position from the UK, right? The dollar is the world's reserve currency, and the dollar has actually been appreciating in this risk-off trade. And to the extent that US yields increased for some reason, let's say some kind of liquidity event, there would be significant demand from global buyers, right, which would support the US Treasury market. The other thing to keep in mind is that at the end of the day, the Fed can step in quite quickly and address any instability problems, in our view. I don't think there's any reason they couldn't do that while hiking rates. Yes, one view is that that would entail hiking and easing at the same time. But I think they can make that clear distinction that any intervention in the bond market, if needed, was clearly related to financial instability or financial stress rather than trying to ease financial conditions.
All right. I don't know whether we can be that sanguine about institutions outside the US. Robert Carnell, before I come to institutions, today, of course, the dollar index has moved down a bit from that 113 levels. But do you see further depreciation in currencies like the rupee and other Asian EM currencies?
Certainly for a while. I think the strength of Fed tightening in the short term is going to be the dominant factor. Yes, we get odd market moves like last night, and currencies seem to follow the equity market rather than following the rates market. I think that's not a sustainable direction. Still at the moment we've got Fed policy which is widening interest rate differentials against most of the rest of the world, and you've got a generalized risk-off sentiment as well, which tends to feed into dollar strength as well. Now I think there will come a point where that flips, and everybody's looking for this pivot, and we might see that before the end of the year. But in the short term, I think dollar appreciation is the way we see things, but we could be swinging around, close to the year end, perhaps even a little bit before that.
Any thoughts specifically on India, Robert? Do you think that the rupee could get even weaker? It went all the way up to 83 almost, and then has pulled back rather smartly. You see more depreciation. Do you think more rate hikes will be called upon from the Reserve Bank? Have you trimmed India's growth macros?
Yeah, we have trimmed the growth outlook a little bit. I mean, we had a 7% figure until a couple of months back, and we're down into the sort of mid-sixes now for the year. And
for this year or for next?
That's going to be the sort of range that we're looking for next year as well. But actually, the outlook for Indian inflation will probably start to look a lot better over the next couple of months, and that should take some pressure off the RBI. I don't think they're quite finished with their tightening. I think we'll get another 25 basis points from them in December, maybe even a slightly bigger one. But I think that inflationary push that's been driving them forward is going to start easing quite significantly over the next couple of months, and will enable them to, at the very least, slow, and possibly through the early part to the middle of next year, we might see some trimming of the hikes that we've seen already.
So the growth trimming that you are speaking about in India, mid-sixes, is for both FY23 and 24? And is that because the globe is slowing?
Yeah, it's because the globe is slowing. It's because inflation is high, which weighs on people's spending power. It's because rates have gone up, which will weigh on investment. You add all the factors up at the moment, and you've got a pretty toxic global environment.
Yep. All right. We've run out of time, though I do wanted to discuss the institutional fabric as well. Thank you very much, Robert and Aditya, for joining us. Well, the verdict is a little more slowness for India and for Asia as, inflation continues to remain high and the world goes into, a tighter financial syndrome. Nothing that we didn't know, just more of the same. And that's why the market perhaps has shrugged it off for the moment. We leave the markets in pretty fine shape. Chartbusters will take the action forward.